This is a very special edition of Futures Now. Welcome to the program. I'm Jackie DeAngelis. Joining me today, both on the floor of this CME, we've got Jeff Kilberg and Scott Nations. Gentlemen, welcome. It's a special show because we're heading into a very special holiday weekend, July 4th, and we're very patriotic. Maybe you can see my flag, maybe not. But we have a lot to talk about here, not just the 4th. We're talking about the markets. We're talking about the jobs number that we got this morning, the impact that that is having on the 10-year note, also the S&P 500. And where do we go from here? Does this change the Fed action as we look out in the coming months? But first, I want to talk about crude oil, shedding about more than 4% yesterday, a big drop on crude, breaking through some major technical levels, but seeing a little bit of a rebound today. Jeff Kilberg, I'm not really convinced that this rebound is significant or for real. We're not breaking through that $58 level. What do you make of today's action? Just buying the dip?
I'll agree with you, Jackie, but we're going to celebrate the 4th of July this weekend here in Chicago like you are in New York, but we're also going to celebrate the fact that we're out of a trading range. It's been a great trading range in crude oil, 58 to 61 for quite some time. We saw that technical breakdown, and now I look to that June 1st low of 58.04. That's a great resistance. Old support becomes resistance, Jackie. So right now I think you want to sell these rips higher. We're looking for a lower price down to 54, 55. Crude oil, the trend has been lower, and they really couldn't get it above 62. That was the bottom line. They couldn't get it above 62.
Right, and it wasn't able to do it. So the first crack that we've had here appears to be to the downside. You seem to think we're going lower. Scott Nations, do you agree? And let me ask you if you think this is the start of maybe something a little bigger.
Well, I think that the 50-cent rally that we see today is absolutely nothing. It doesn't count for anything. Why? Because the fundamental news that we got yesterday when you mentioned that the crude oil broke more than 4%, the fundamental news was horrible. It was absolutely terrible. Right. Whether it was the build here or the fact that OPEC says that they're going to keep just pumping oil like crazy in order to kill the shale producers. Right. That's not how they put it, but that's what they're trying to say. The fundamental say that crude is absolutely headed lower. Is this something more or the start of something more? A little bit of something more, because we're not going to go back down to the lows that we saw last year, but we are definitely headed lower.
And we did see some fireworks on that close yesterday, Jackie. You saw it there at the NYMEX. They really hit that close hard.
Yeah, we did. We did hit the close hard. And here's my question to you, Jeff. We've talked about summer driving demand holding up the crude price in that trading range that you talked about. We may get a little bit more sort of love from driving season, but maybe not that much more. When that demand falls off and it piles on with some of the factors that Scott mentioned as well, how low do you think crude could go? Maybe not the old lows, but a four handle?
No, I don't, Jackie. I don't want to oversell this volatility we saw in oil due to the dollar last summer. I don't think we see that same type of volatility. We are in a nice trading range, $3-4 a crack here. So now we have a new range, 58. I think we go down to 54. So not overselling the volatility, but play the range. Traders get excited about this, and if you get into the futures contract, you have the ability to play this and look at the seasonality. I think you're absolutely right. We're going to see a little bit of a boost going into the weekend after that big drop. I think being short here, and I want to give you the trade, Jackie. I want to be a seller at this 58.04. That's the June 1st low, which is now great resistance, about 50 cents higher. I'm looking for a $2 drop down to 56.04. Being mindful of crude oil volatility and geopolitical tension, which can always rear its ugly head, a dollar higher stop.
All right, Scott,
I might even,
how do you like it?
Yeah, well, I like it. He's absolutely got the direction right. I would actually probably be a little more pessimistic if I were a bull, a little more optimistic if I was a bear. I might look for 10% from here, which would be not quite $6. Now, that doesn't get us below $50, but that's a nice sell-off.
Pigs get fat, hogs get slaughtered, Jackie.
But that's not. 10% is not that much from here.
Agreed.
And he is right. There is a floor here. I mean, OPEC is not going to continue to pump at this production level if they see crude oil driving down to $30 a barrel.
Right.
I mean, they're not. They're not crazy.
Let me ask you this, Jeff. Yesterday, there were some rumors floating around, some reports that still haven't been confirmed, that maybe these talks, the nuclear talks with Iran, the negotiations, will come to a framework kind of a deal. And that was really when we saw some steep selling. If we do hear something about this next week, for example, could that be a factor that you're not necessarily considering that could take us substantially lower?
Without a doubt, Jackie, and the whole Iran nuclear situation is akin to the Greece drama, right? I mean, it's the same developing story. I don't even know what act we are in the Iran nuclear situation, but you're absolutely right. That type of shock to the market could really light up some fireworks and really get those Roman candles going. Do I have any other 4th of July analogies I can utilize here? M80s, cherry bombs, you name it.
We're talking about crude oil. I don't think with flammable crude oil we want to be talking about fireworks.
Right.
Stuff's going to blow up.
It'd be a hell of a show.
And nuclear issues as well. Gentlemen, I do enjoy the 4th of July puns, but maybe when we're talking about bonds or the S&P 500. Having said that, let's go ahead and bottom line this trade here before we move on. Jeff is trading crude oil to the downside, selling at 58.04, targeting a move to 56.04. Since each point is worth $1,000, he is risking $1,000 to make double that. All right, let's go ahead and move on and talk about that jobs report. Joe Labornia with Deutsche Bank is on the phone with us. Joe, always great to have you on the program. You know, let me just review for people who may not have seen it. We had a print of 223, unemployment rate 5.3%. The headline really appeared like it was a good jobs number, but then when you dug into it a little bit, it wasn't so great. So people are reading this to be dovish when it comes to the Fed in terms of, you know, a rate hike potentially being delayed, right?
That's right, Jackie, and thanks as always for having me on. The headline number at 223 was decent. It was about equal to what the year-to-date average monthly gain had been coming into today's data. The rate falling was good news on the surface. However, the unemployment rate fell because labor force participation hit a new low. We're now at 62.6, and to put that in the right context, we've not seen labor force participation this low since the 4th quarter of 1977.
Wow.
And at the same time, Jackie, we saw flat average hourly earnings, a small downward revision to May. So over the last 12 months, earnings are up just 2%, and that's making investors and bond folks more confident the Fed is not moving in September. And that's really why the report was dovish.
So let me ask you this, because I'm watching the markets here. We were higher initially on the report. We've come off. Now we've turned negative in terms of the equity market. And the equity market sometimes, you know, could read a report like this as dovish and continue to stay higher. Why is the market selling off today in this particular way?
I mean, to me, it's, you know, that's the first day of the month, so it's a long way to go. I think people are really worried about Greece. The data on the surface, Jackie, are actually very good for equities. Maybe not today because of positioning, but certainly in terms of the economy growing, no inflation, the Fed stays super easy. This, to me, I think ultimately will be construed as being a good report for the stock market. And the issue is what happens over the weekend with Greece. If there's some clarity early next week, I think equity investors can come back and look at the recent data and say, you know what, retail sales were better, inflation's low, jobs are still pretty healthy. Jobless claims we didn't talk about, they're still well below 300,000. This is still a very good environment for equity investors. The bull market will continue.
Okay, now let me ask you this, sticking with the jobs number, sticking with the data, because the Fed has said that it is data dependent. In terms of how you think this will impact a rate decision, you know, potentially pushing it off maybe to next year, will the market digest that well? Because the market is really prepared for that September hike.
Well, it had been, Jackie, but basically the recent FOMC meetings of 2 weeks ago, combined with just very tame inflation readings. I mentioned the earnings numbers today, but a couple of weeks ago we had some very low personal consumption expenditure deflator numbers, has gotten the bond market thinking the Fed may not go at all this year and that it's getting pushed out until March. The Fed, however, will want to buy some optionality, meaning the Fed will want to keep the possibility of a rate hike on the docket for this year, possibly September, but certainly in December. And therefore, their rhetoric will not necessarily sound as dovish as perhaps analysts might couch the data. The problem, Jackie, is if they wait until next year, you're going to find that the old adage is, you know, never a good time to quit a bad habit. And I'd argue policy is so easy that it probably has become a bit of a bad habit, but you have the election. So I do think the Fed, if they can, would love to be able to hike this year, but the data right now are not that compelling, and unfortunately, I hope this is not the case. If the Greek drama continues through the summer and markets become more volatile, then that's another reason the Fed's going to stay its hand.
Right, yeah, it creates a global situation that the Fed has to keep an eye on. Obviously, these markets very, very interconnected. Scott, question for Joe.
That's right. Joe, you make a good point in that while the Federal Reserve now seems unlikely to move in September, there's still two jobs reports until that September meeting. What do you think we would have to see as far as jobs are concerned from those two numbers in order to get the Fed to actually go ahead and raise in September? Would 250 and 250 do it, or would it require something more like 300 and 300?
Scott, I'm still of the view they're going in September because I think the economy generally is still pretty healthy and the job market's good despite today's report being okay. If we're 200 plus, it can be even 2.25. If that rate continues to fall and we start to see some average hourly earnings, if the next couple of reports we see 3/10 earnings and we see job growth at 2.25, that to me would be enough. But it's not the growth numbers per se, it's the inflation numbers or the wage numbers that have to really start to reverse. And could it happen? Yes, it could still happen by September. You're right. There's a lot of data between now and then, and that's the tricky part is how the next couple reports look like. And right now it's anybody's guess, but the market's making the guess that, look, it's not going to turn around in time. September's off the table, and I think that's probably a little too aggressive.
Right. Okay. Joe Livornia, thank you so much for giving us your perspective. We'll have you back on soon. Meantime, I want to get straight out to the bond pit and talk to you, Scott, about the 10-year note. How do we trade it short term off of this?
Well, I think we want to be short the 10-year, and why is that? Because it's still, and Joe touched on this, it's still when, not if, the Fed is going to raise rates. And I think that, like Joe, I think September is still a possibility. You have to kind of get under the hood of today's numbers to really feel that September is unlikely to happen. And we have two more numbers, and the Fed wants to raise rates. They absolutely want to.
Well, hold on. Jackie, Scotty's one of the smartest guys here in Chicago on the trading floor, but I'm going to push back here just because that trade, not if, when, that's been killing people since 2012, right or wrong. So to be short bonds now going into this uncertainty, I'm opposed.
Well, but they are talking differently now. They have said, several of the Fed members have said that they do want to raise rates this year. And it's not just the Fed. If you look at the 10-year chart, look at the chart of the 10-year futures, we're seeing lower highs, lower lows. The momentum is still down.
That Joe just made, which is if you don't raise them this year, then when? It's kind of, we've talked about this spiked punch bowl, sort of a crack-addicted market. The longer you prolong it, the harder and harder it gets to wean the market off.
And I think they have to go in September. And Joe kind of finalized that point and put a little polish on it. They have to kind of mitigate that political aspect, which is 2016. So
yeah, there's so many variables. He mentioned Greece too.
Yeah, it was unbelievable. But I think the direction from a technical perspective, we're back under this 242. It feels very languish. Every time we tried to see the sellers, those bears would come out, they'd push it down. They just didn't have that follow through. So right now, with the uncertainty of the Fed, coupled in with some of these geopolitical tensions, I don't see how a follow through on the downside of prices, upside in yields is happening short term.
All right, Scott, levels on the 10-year note trade for me.
Sure, and this is interesting. Greece and what we see today actually lets us sell today at a better level. So I want to short the September 10-year futures at 126 even. That'd be just a tiny bit below where we're at right now. My target would be 125.08. That's the level just before the number came out today, so that's why I'm picking that level. My stop would be 126.20. That's above the 50 and 200-day moving average. So if we get through those levels, then I want to be stopped out. But the interesting thing here is that you get a couple hours to trade this. You really have to be brave if you want to take this through the weekend, though.
Yeah, no, absolutely. Right now, the bid is 126 even. So I don't mind the technical levels because there's a back and fill. There's a gap on the chart off this number, Jackie. But at the end of the day, I'm not on board here because I see us under 242. I see continuing buying. And if we do get some disruption, some firecrackers out of Greece, sweet Jesus, you will see more people come in and buy bonds.
All right, guys, let's go ahead and get the bottom line on the 10-year trade. They don't agree on this one, but Scott is a seller here, 126 even, targeting a move to 125.08. Since each tick is worth $31.25, he is risking $625 to make $750. All right, let's move on and talk about the S&P 500 and how the jobs report, how Greece, all of these factors right now are impacting the markets. It's sort of been a seesaw, but maybe a mini seesaw. We kind of called it a teeter-totter back and forth, gentlemen. The question is, where do we go from here, and how is the market going to digest the next few weeks of news that are coming out? Jeff, your take.
Well, we're certainly looking at Sunday. 4th of July here is Saturday, but the 5th of July could be the real fireworks. We don't know. It is a real wild card coming out of there. Right now, you are seeing some low volume, some people kind of shoring up their positions going into this. So we have seen the S&P is down 8 1/4 handles right now. So right now, you see going into the weekend, people aren't taking any position. And from a futures now perspective, you have to be really careful. If you have some type of position on going into a July 5th potential event, markets can gap, and your stops that you have in place could gap and get filled at a higher or lower price. So you got to be really careful and mindful going into this weekend.
Yeah, Scott, what do you think? Do you even
right.
want to be in the market? Do you want to have a position on going into the weekend, or just take it off and go to your cookout?
Well, here's the thing. We might get some fireworks, so there is some opportunity. So if you're a trader, how do you take advantage of some opportunity? You have to size your trade appropriately. You have to size your position appropriately. And so I don't want to have a full unit on through the weekend. It doesn't matter if it's crude oil, treasuries, or S&Ps where we might see the fireworks. But you want to right size your position given that we're going to have a 3-day weekend. We got all this going on in Greece.
That's always a great tip. So speaking of that, Jeff, what are the levels on the S&P 500 that you're watching at this point? Live trade it for me.
Well, the levels I'm looking at, it was the unchanged level, 2071. That's where the VWAP was this morning. I wanted to be a seller there, but I missed that boat. Should have had the show 2 hours ago, Jackie. So right now, we're down 8 handles at 2063. I want to bet the fact, a one lot here, a very small conservative bet, a one lot here, that we are going to see Greece take the deal that allows them to kick the can further down the road. We open up a little higher. So be a buyer right here at 2063. Be prudent, be smart, put your orders in. If you are going to take the risk of going through the weekend, look for 10 handles higher at 2073. Keep your stop lower, a lot tighter on the stop than my typical stops, Jackie. 5 handles lower at 2058.
Scott, do you like it?
Well, I think the interesting thing is Jeff is a fancy trader guy, so he uses this VWAP term, volume weighted average price, which is an indication of where the market tends to be long or short. And so he's focusing on this volume weighted average price. That's kind of interesting. If we get some good news out of Greece this weekend, then the S&P is going to be higher. I understand what he's thinking, and he's absolutely right that you want to right size the trade. So fancy guy, VWAP. Fancy term.
He's the one with the handkerchief here. I'm not fancy. He's fancy.
Well, I'm fancy, but I don't know. You're the number guy, evidently.
I'm the killer.
God, we can argue about everything. We're arguing about who is fancier now. Gentlemen, let's go ahead and get the bottom line. Jeff, give it to me.
So we're 2063 buying. We're trying to make $500, risking $250 with a stop. 5 handles lower at 2058, Jackie.
And keep your hands off my.
It is nice. And unused.
All right, that's going to do it for today's program and the fireworks on the floor of the CME here today. Thank you guys so much for logging in. Remember, if you missed any portion of the program, go back. It's all on the website, futuresnow.cnbc.com. Otherwise, enjoy the long holiday weekend. Stay safe, stay healthy. We'll see you next Tuesday.